Hey traders, Ed here from Revolution Swing. We all should know by now that a major key to success of trading is having a sound strategy and trade plan. They govern us on what to look for in trades, when to enter, when to take profits, and when to stop out. However, I'm here to tell you that knowing when not to trade and just sit on the sidelines is just as important. And in this video, I'm going to go over my top 3 reasons why I won't take a trade. So without further ado, let's get into it. Reason number 1, risk. Sometimes with swing trades, there could be multiple support or resistance areas to watch, whether it's a long or short play, and depending on the play, you can start getting pretty wide with your risk, depending on where your entry points and stops are.
All right, guys, so I'm going to give you a little example of what I mean by risk. And if it's beyond what your risk is, whether it's mental capacity, like, what you can handle mentally, what your account can handle financially, then you just don't take the trade, right? So I have Boeing up here. I marked up a couple levels. They mean nothing. They're just there for example, right? So let's say you were looking to do this as a long, right? Swing it long and try to get it all the way up here, right? And you look at it and you're like, you know what? It could bounce here, it could bounce here, it could bounce here, and it could bounce here, but this is going to be my stop, right? I don't want anything to do with it if it gets past this level, it breaks this level, right? And like mentally the amount of risk you can handle, right? The emotions, the sweaty palms, the things like that, right? You should have a gauge on what you can handle mentally, and you should definitely know and have a gauge of what your account can handle financially, right? So you could build your trade plan, a couple different ways, but risk and trade plan, they kind of go hand in hand, right? And if the trade doesn't fit in it, you just don't take it, right? So I'll show you what I mean. So let's say in your trade plan, your first example of a trade plan, you're like, it could bounce here. I can enter here because it could bounce. I could enter here because it could bounce, and it has the potential to come all the way down here and maybe retest, right? Before it bounces and starts making its larger leg up. And you're like, you know what? Financially and mentally, I can't handle the burn if I were to enter here and ride it all the way down. Okay. And then you assess things and you're like, you know what? I can't handle the burn here either and ride it all the way down. It's just too much, right? My account can't handle it. I mentally can't handle it, right? Because you have to go into these with an idea of, the amount you're going to risk, right? Especially if you're trading options. Options get a little hard because the volatility kind of alters things a little bit, but there's still ways to kind of have a gauge, right? And so you can build your trade plan around your risk, and you could, your risk will, they kind of go hand in hand, right? So there's a couple ways you could do it, but either way, if it doesn't fit in your trade plan or your risk parameters, you just don't take the trade. You just gotta let it go, right? You just sit back and do nothing about it, right? So if you're like, you know what, I can't handle from here to here, and I can't handle from here to here, but I can handle from here to here, and I can handle an ad. But if it breaks that, obviously I'll get out, right? So in that situation, you don't enter here, you don't enter here, and you wait for this. And if it doesn't come here, you don't take the trade. Who gives a shit if it decides to hold here or here and go without you, right? You just don't do it. Let it go. You know, part B, let's say you build your trade plan and you're like, you know what? I can enter here, I can enter here, but I can't handle all the way down. So if it breaks here, I'll take a small paper cut as long as I size appropriately, and I can reset here because I have the ability to hold or enter here and hold it down here, right? So you can do that too. But at the end of the day, if it doesn't fit in your trade plan, it doesn't fit in your risk parameters, you let it go. And that's what I mean with the risk example, guys.
Reason number 2, uncontrollable factors. There are a million things that can happen in your day-to-day life that can effectively alter the outcome of a trade, even if the trade looks sound. Mindset plays a big role. Let's say your car breaks down, a family member gets sick, you got financial issues. These all have the ability to take your head out of the game and potentially trigger you to make a decision that you probably shouldn't. These are times that it's probably best just to sit back, relax, because sometimes the juice just isn't worth the squeeze. Reason number 3, current events. A really good example is the election that's happening right now. There is no way in hell to determine how the market will react based on who wins. And entering a swing on a hunch is no way to trade. When there are major news events, the market can have some pretty violent reactions, and if you're on the wrong side of the move, your account could get seriously damaged. So those are my top 3, folks. I hope you enjoyed the video and I hope you learned something. So remember, if you want to get properly educated on how to trade stocks by a true professional, head to tricktrades.com. And if you want to grow your account with killer swing trades, head to revolutionswing.com. So until next week, this is Ed signing off.